Welcome into my Vanguard portfolio update now, the final one for the calendar year of 2023 as we close out December. Now, this one's going to be a little bit more different and a little bit longer than usual because we are going to spend some time going back of the most notable news stories throughout the year, and I'm going to give them a little bit of review and kind of make sense of how we've ended up in the position which we've ended up today. Because let me tell you one thing, it's definitely very, very different from what a lot of analysts thought and a lot of people thought if we go back to the start of the year. First things first, as usual, let's have a quick look at some of the markets to see how they've done. As you can see, the S&P 500 had an absolute tear this year. It's up around 22% at the time of filming. Anything can happen as we have those final few trading days left in December. But wow, what a year it's had. So that is well and truly into a bull market. Now, just a quick one to note on this one, and a few of you have commented this before, but the returns you see on the S&P 500 chart on Google here, for example, aren't necessarily the returns you get as a UK investor. If you're invested in a kind of a UK-based fund like VUSA or even VUAG from the likes of Vanguard. Now, the reason for this, just remember, is that exchange rate between the pound and the dollar. And as that fluctuates throughout the year, that will kind of dictate your returns. If the pound is strong, you're going to get more for your money. When the pound is weak, you're going to get less for your money when buying, and then vice versa when it comes to selling. Now, in the short term, anything can happen, and there's not really many ways around this. But in the long term, it will kind of even itself out, or at least you'd hope so. And I guess that's another reason why diversifying your portfolio, personally from my perspective around the globe, is a very important thing to note. But just one thing worth saying, because some of you will probably look in your accounts thinking, I invested in the S&P 500, where's my 22%? Now quickly, close to home, let's have a look at the good old FTSE 100. Flat for the year, around 7,560 points as time of filming. But total returns for the year, as we do need to include dividends in this one, of around 3.5%. Now, this is also a quick lesson that whenever you do look at price charts for any indexes like the S&P 500 and the FTSE 100, you do need to factor in dividends. All of these charts are just price returns, so they do not take into account the fact that a company pays a dividend because that dividend is paid out as cash. It does not take into consideration the fact that that cash may get reinvested. That only works if you invest that into an ETF or a mutual fund, so just be aware of that one. And quickly, let's flick over to the FTSE 250 because I think this gives us a bit more reflection from a UK perspective. You can see we're down 2.2% this year. So really, that's a terrible performance when you compare that to something like the S&P 500 rallying more than 22%. So combine that, you've nearly got a 25% miss if, for example, that's all you invested into. And I hope nobody watching invested all of their life savings into the FTSE 250, but hey, personal finance, that's your choice. And finally, let me just quickly throw a last one and actually just kind of review that year. Let's have a look at the FTSE All World. So I'm going to grab VWRP here, but there's lots of other trackers which will track this kind of global market. It is up 13% this year. Again, bear in mind you have two things taking place here. You do have to factor in the exchange rate. And the second important thing to say is most of this is made up from the US market, so you are getting those gains there. But it just shows the slight skew of investing just into the US versus just investing into the whole world, that you may not necessarily get the returns of the S&P 500, even though we kind of put this up as the market and thing to beat. But it does just show how hard it is to beat that one, at least at the moment. Moving forward, who knows? Anyway, now it's time to have a look back through the year and have a look at some of the key news stories that have kind of shaped this financial year for us, and just go back at some of the key notable news stories that I've got up here. And let's just start from the beginning as we headed back to the start of the year. So I think this year was heavily shaped by two key things, inflation and interest rates. Now, if you have a look on screen now, we'll go through two key central banks, the Fed in the US and the Bank of England here in the UK. As you know, over the past couple of years, interest rates have been risen at their fastest rate ever and now sit at around 15-year highs, both in the US and in the UK. From a UK perspective, the Bank of England started the year at 3.5%. They now sit at 5.25% with an expectation that they get held steady for quite a while. Over in the US, the Fed started the year around that 4.25 to 4.5% mark, and they now sit at the 5.25 to 5.5% mark, widely again expected to be held steady for quite a while into 2024. Now remember that all those rates were increased in response to the huge amounts of global inflation that we saw due to the post-recovery of the global pandemic. We saw huge price rises in commodities, in pretty much everything we wanted to buy. And don't forget the very small problem you have when you print loads and loads of money and pump that into the economy. Ultimately, more money in the economy does lead to higher prices because you have more money chasing the same amount of goods. And the problem we had with lots of supply chains around the world was those supply chains were even more constrained because of the post-pandemic recovery that made things even worse. Now, you could absolutely argue that a lot of those interest rate rises haven't necessarily filtered through to the consumer or filtered through to every single person just yet in the economy. I think it really depends where you stand. For example, when we think about mortgages and the rates of interest which we might pay on our mortgages, they're very much dictated by those interest rates from the central banks. However, in the US, for example, most of their mortgages are on long-term 30-year fixed deals, and many people got their deals around kind of the 2 to 3% mark. And until they have to remortgage or buy another house, they're not going to see an increase in their mortgage rate. Whereas in the UK, our fixed terms are much shorter. So when we have to go and remortgage in 2, 3, or 5 years, we will then be hit with that much higher rate. And going from around a 2% rate to something like a 5.5% to a 6% where things stand now will impact people and have a huge impact on household finances. Many people are either going to have to go into default, extend their mortgage, or potentially just find cutbacks in other areas to find maybe £200 to £300 a month for many households up and down the country. Now, quickly on the flip side, with higher interest rates has brought some incredible rates for savers and anyone interested in getting some better rates on their cash. Before, when rates were really, really low, the only option you had was really to put your money into assets like property and the stock market, and really those cash savings accounts were virtually zero. So all that money you had in your cash ISAs were giving you 1% or something like that. But now you can find cash ISAs giving you much better rates. Now, I will do a video as we go into 2024 about looking at different rates for savers and also going to compare investing and saving, but I'll put that one coming up very soon. Now, the second major story of the year happened in March, and we had the collapse of Silicon Valley Bank over in the US. This bank was the first to go in March the 10th, and then Signature Bank followed very closely after. Now, Silicon Valley had a big problem because they were looking to raise some capital, and this set some alarm bells off from the different founders and the different investing groups who had their money in the bank. And lots of them ultimately pulled their money out too quickly for the bank to service that amount of cash. Now, the problem was on Silicon Valley's balance sheet was lots of long-term debt. And that long-term debt was government bonds held at a very, very low interest rate. Unfortunately, as the Fed pushed those interest rates higher and higher, those bonds on their balance sheet became extremely worthless, and they were forced to sell them at a loss, which then led to them having less and less money and ultimately led to the collapse of the business. Now, arguably, the bank could have survived if people didn't all try and rush to take their money out at once. But many people had millions and millions of dollars in there, which is above the level which is insured by the FDIC in the US, so you can't really blame people. But this does show us how important trust is in the whole banking system globally. Ultimately, if everyone wanted to pull all of the cash out of their bank in one go, many banks, and I think most banks, would have a huge issue because they haven't got enough liquid assets to actually pay back those depositors. So really, you need to trust that what's in your bank account can be yours at any time you want, just not taken out all at the same time. Now, closely after Silicon Valley Bank collapse, we also had Signature Bank close in the US as well for similar reasons. Again, another one of those smaller regional banks, which did lead to lots of people speculating that those regional banks would also have lots of issues. It did kind of force the government to step in and the US to say that people would all have their money protected and deposited would be okay in the end. Now, closer to home, we also weren't immune from all of this, and Credit Suisse, one of the biggest and oldest established banks in Europe, were bought by UBS in the end. Now, another big story this year was the amount of people laid off from tech companies throughout the start of the year and also the middle of the year too. We saw thousands and thousands of people laid off as those big tech companies and some of the smaller ones realized they'd overhired and employed so many people from 2021 and 2022. But just leading on from that, you can see employment in the US, unemployment especially, actually still remains at all-time low. So apparently, all these people must have got jobs somewhere else. Now, this final story of the year arguably has contributed to where we are today in the stock market. If you have a look on screen now, we're pretty much talking everything AI and artificial intelligence. Now, I think the biggest story of the year was the rally in the stock market caused by that boom from the likes of ChatGPT, which became the fastest growing app of all time to get 1 million users, getting that in just a few days. You can have a look on screen now. We compare it to some of the other technologies which struggled to get 1 million users in much faster times. And as I mentioned in my last portfolio update for my InvestEngine platform, pretty much every company in tech has now entered the race to prove how good their AI is. And anyone who wants to release a press release right now must use the words artificial intelligence, and that instantly gets you a bump up in your market cap. We also had Nvidia reach $1 trillion market cap as being one of the only companies that supplies these chips needed for companies to actually create these AI technologies. All of big tech have rallied, shooting past some all-time highs with no clear winner in sight. OpenAI, which is 49% owned by Microsoft, had a crazy week when Sam Altman was fired from the board of OpenAI, hired by Microsoft, and then rehired by OpenAI. At least I hope I got that right, and that's what it is at the moment. And just leading on from that one, the Magnificent Seven, all of those big tech companies have actually accounted for almost all of the gains of the S&P 500 this year, resulting in that 22% gain for the index, which is something that nobody saw coming. Now, with the news out the way, I wanted to do something a little bit more interesting here, and I wanted to go back and see what some of the analysts and the experts thought that this year would bring. And I've gone back to a JP Morgan report, which was released in the summertime of this year. And I thought, let's see how good some of their predictions are, because come on, we're only 6 months away from July. Surely they must have got things right. And I think you're going to be really interested in some of the results as I pull them up here. So let's have a look at this JP Morgan half-year report now on screen. I'm going to go through some of their predictions because they are really interesting. JP Morgan Research expects the US to enter a mild recession near the end of 2023 as the restrictive policy stance from the Federal Reserve creates tighter credit conditions, gradually dragging down growth. My response to that, I actually wrote lol. The US economy has been way more resilient. There's no recession in sight. Now, GDP has actually risen faster than expected. The current annual rate is at 5% right now, which is incredible. Also, I noted down that employment also did not rise as they expected, and inflation has come down faster than they expected, almost 3% in the US. And jobs have been created at a really, really fast pace. There's no signs of slowing down. So, unfortunately, a big negative one for them there. Secondly, stock market outlook. Now, this one's pretty funny. They say, given that multiple expansion has been the main driver of performance year to date, we see unattractive risk reward for equities and increasing investor complacency ahead of our expectation that the business cycle will further decelerate in the second half of the year. In other words, they think it was a very expensive time to buy stocks because everything was overvalued, therefore you got to wait and everything's priced in, yada, yada, yada. Now, what actually happened? So now let me put on screen their actual price targets for all the different markets around the world, because I think these are pretty funny, really, and just shows that you can just pick a number from thin air, put it in a paper, and charge people for research. This really is a game that I need to get myself into very soon. So have a look here. The S&P 500, they reckon, would be 4,200 points, down 5% where it was just in the middle of the year, remember. The FTSE 100, they reckoned, would get a huge rally of 7% up to 8,150 points. I think we all know where they pulled that number from. And then even China, they put a growth of 3%. So all of these numbers are completely wrong. I really don't know where they got them. I mean, it just shows how difficult trying to make predictions is. This isn't like the start of the year where they have 12 months to try and work things out. This was only 6 months ago, and it just shows how difficult it is, and also how amazing it is, really, that people can be given full-time jobs with real salaries to make predictions that are so wrong. Honestly, we're in the wrong game. And just a final prediction on stock markets, which maybe we'll have to touch on in a few years' time, but they say over the next 3 to 5 years, JP Morgan's hierarchical Bayesian model, HBM, we all need one of them, of expected returns continues to suggest headwinds for equities, attractive returns for bonds and credit, and a challenged US dollar. So we'll see how that one pans out. Again, trying to make long-term predictions about the stock market and equities and all these kind of things, waste of time in my opinion. And finally, this one's a good one. Let's have a look at commodity markets. So oil, gold and wheat, here they have on screen now from their report, and let's see exactly where they are. Right, we'll start with the good news. Gold, they pretty much got spot on. That is very much close to 2K an ounce, so I hope they get a pay rise. They can keep their jobs for one more year. Wheat is apparently at $6.34 right now. That's nowhere near their target price. It's gone down huge. Oil, again, nowhere near their target price. Well, that's $73, so pretty much back down to where it was at the start of the year. There were lots of fears, of course, that oil could top $100 a barrel, etc., and gold was going to go through the roof and everything was going to go up, but clearly it didn't happen. Anyway, that was a bit of fun. Now, you can do the same with pretty much any company. I don't want to pick on JP Morgan, but pretty much any major bank or major investment house make all kinds of crazy predictions from Q1, Q2, Q3, and no one can predict the future. It just shows how difficult it is. Now, a quick lesson here really is a reminder to just follow your own plan. Anyone who kind of changed their investment decisions based on reports like this from any of the major banks really probably would have lost money this year. And that's not to say that we can't have a very terrible 2024 and things can't go negative from here and everyone should put all their money into investments. That really is a personal decision. But basing it on guesses and estimations, I think is just absolutely insane. So just another reminder for you to follow your own plan and stick with it. And actually, I did do a video, which you can have a look at the end, which goes along some of the things, some of the lessons that we could have learned from the last year. Okay, finally, time to have a look at the portfolio. And to no surprise from everything we've covered so far, we are now sat at an all-time high in this account. Let's have a look at how we're doing, how we're getting on. So quick recap if you are new here, this is my personal portfolio, both made up of an ISA and a self-invested personal pension, both of which I don't contribute to anymore. So this has just been left to sat there from two different contributions, which I'll show you in a moment. And then we just kind of let this one ride throughout the year to see how things gone. And I've joined you on that journey of all the ups and downs, which we're going to dive in just a second. If we start off on the performance page, we can have a look how we've done. And you can see here, we are now sat at an all-time high of just over £58,000 value for the pension and the ISA. Now, the all-time high that we had to beat previously was just under £57,000, and that happened in the summer of 2022. And you can see also the graph of how I actually put money into this account initially. So I did start my Vanguard account with an ISA, which started in October 2021. I let that one grow and I put a little bit more money in as I went along. And then also I moved everything across from my various pensions, as you can see here, around April time in 2022. And I've invested everything into a single mutual fund, which is the FTSE Global All Cap accumulation version. I don't get any dividends. I don't have to think about any rebalancing. Everything's just set and forget, nice and simple with this account. Now, here's an interesting one as well, going back month by month. I'm always a big fan of this one, as you can see, because we weren't always in the green. In fact, you have to just go back not very many months, and you can see this account was actually deep in the red. So have a look here. As you can see, December 2022 was really, really bad for this account. And you can see if you look through the different investment returns for the month and the cumulative returns on that second column here, things change and how they kind of flipped around. But you have to put up with those bad months and look at that to actually get those green in the end. Again, as you go through the months, so January was pretty good, February not so good, then we had a bit of a steady run through the spring period, and then the summertime we did have that kind of first step of the rally. But then also toward the end of the summer, we did see things fizzle out. And then all of a sudden, November and December, that kind of Santa rally has finally delivered for us. But it just shows the ride you have to deal with as an investor. And this really, don't forget, is a short period of time, 1 year, 18 months. These are really, really short periods of time. I mean, really, to be talking long-term as an investor, you've got to be talking 5-10 years, really, at least. I think anything sub 5 years, you're in that kind of gray zone of saying long versus short term. So just be really, really careful when you are investing. Remember, I'm not a financial advisor. You really do have to find out what's right for you. But either way, you are going to have to put up with this roller coaster ride. And on that roller coaster ride, don't forget that, I mean, this is about as diversified as you can get in terms of global stock. This is a FTSE Global All Cap fund covering the entire world. If you're invested in individual stocks, then you would have seen volatility go crazy, especially some of the people which we see on YouTube here in the UK and over in the US. Some of their portfolios, yeah, sure, they might have had a good year and a bit of a recovery, but oh my God, they've got to put up with some huge volatility. If you can stomach that and you want to take that risk, that's the route you're going to have to go down. But for me, even with this level of volatility, I mean, that's quite a lot really to try and put up with. So you've got to kind of find that balance and then really work out what returns are going to be from there. Now, a couple of more things worth going through, and thank you for many people in the comment section who pointed this out, but Vanguard do have some new funds on the platform, which I think do make things more interesting. They've got a few accumulation versions of the different ETFs on their platform, which I think do make a huge difference to what you can actually invest in. And I am going to make some new videos in 2024, in January especially, to go through kind of my best index funds. So I do need to advertise those and actually upgrade some of the videos I've got, because some of the most popular videos on my channel are kind of, you know, best portfolios and best kind of index funds to invest in on the Vanguard platform. So I need to update those, but I'll do a full video on those rather than kind of go into that one today. But I do think now on the Vanguard platform, at least, you do have some more choices, whereas before you had to go to another platform to get access to Vanguard funds, which just makes things really complicated as an investor, especially if you're a newbie thinking, what the hell do you do? Now, plans going ahead. While I talk about that, I'll just put up the holding section on screen now so you can see what a global fund does and how it actually goes around market cap, market weight, and what you're actually invested in. Now, future plans for this portfolio. As you know, I don't contribute to this one anymore. My current stocks and shares ISA is with InvestEngine, which I do monthly updates for that one. If you're not aware, you can go back and watch all of those from when I started that one. But eventually what I would like to do is contribute more to a pension, definitely. But the ISA for me is where I prefer to start. And if I can potentially even max that one out and contribute as much money as possible, a pension for me is where I would put the second set of my money. I do think if you are in a workplace pension, for example, and you work for someone else, that's probably the first thing you want to max out. And really, you should be maxing that out as much as you can because that's free contributions of free money. But for me, I like the flexibility of the ISA and the fact that it's tax-free on the way out. Remember, with a SIP or a pension, it's taxable on the way out. So it can grow with those big contributions from your employer, or from a SIP perspective, you get that top up from the government. But once you take that money out, remember, it has to be taken out at pension age. At the moment, it's what, 58? But I imagine by the time, you know, people my age, I'm 35 at the moment, so by the time I get to retirement, whatever they want to call retirement, it's probably going to be somewhat time into 60s before I can get hold of that money. But it is a really good vehicle, a really good wrapper to be able to invest. But for me personally, I focus on the ISA first, and then I'm going to try and put money into my SIP where I can. And really, it all depends how I grow the business. And my business is this YouTube channel and all the different things I do. The financial coaching, affiliates, ad revenue, all those kind of things combined. And eventually, who knows what else I'll be able to do. Anyway, that has been a whopper of a video. I'm sure this has taken me ages to edit. I hope you've really enjoyed this one. Thank you so much for the support throughout the year, and I hope we have a really successful 2024. Look out for many, many more videos. Now, as I said earlier, there's two interesting things you can do now. I can give you a playlist here for all of my portfolio updates. If you're bored, sat there with a tea and a mince pie and you want to go through all of them. Or secondly, have a look at my latest video, which I would have published by the time I've actually edited this one. And this is some of the lessons that I've learned from last year. And I think that some of them are going to be really, really valuable. And I hope you agree too. Anyway, thank you so much for the support as always. I will see you in the next video. And as always, happy investing.